7 minutes past 7 o'clock. Jameel Ahmad, who is the global head for currency strategy and market research at FXTM, joins us on the line with Martin Strauss, head of strategic investments at ShareNet Wealth, also joining us in studio. Jameel, good morning to you. I suppose my first question is that Chinese stimulus is certainly helping global markets, particularly emerging markets. But at the same time, one has to add that the bull run in the United States is certainly shaking things up as well.
Good morning, and thank you very much for having FXTM on as always. So this news from the end of last week from the PBOC and the Chinese authorities that essentially what they tried to state is that they saw that the Chinese yuan should remain stable over the medium and longer term. And what this managed to do is try to provide reassurances to investors that Chinese yuan weakness isn't something that we should expect to continue, which should help provide a lift to emerging market sentiment. Additionally, what this comes back to is that the PBOC and the Chinese authorities are very committed to defending the psychological 7 level, which is something that the Chinese yuan looked at risk to approaching just a week or so ago. There's other things that are also helping sentiment. Jerome Powell's speech from Jackson Hole seemed to indicate to some that the Federal Reserve might not be so aggressive towards U.S. interest rate rises in 2019. I think that one's a little bit too early to tell. And then, of course, this trade breakthrough between the United States and Mexico yesterday, this is also helping guide market sentiment.
Yeah. Martin Strauss also joining us in studio. As I said a little bit earlier, Martin, everything that Jameel has said there, including, of course, that NAFTA deal between the U.S. and Mexico, is certainly moving markets, shall we say.
Yeah, absolutely, Arabella, and it's been a sort of perfect combination for emerging markets as well, and definitely for the resource sector specifically. If you look at potential weakening of the dollar as a result of a dovish stance in Jackson Hole, fueled by Chinese stimulus, as well as a fear subsiding of trade wars, it's been a perfect combination, and we've seen good performance from emerging markets specifically.
Yeah, I suppose that emerging market picture is one to look at for quite some time. Taking a look at the Rand 14.20 as well against the US dollar, Jameel, there seems to be some sort of, I'd like to call it sideways movement, because it really is just range bound. But can we see a better move for the Rand, considering now, everybody's back on board, particularly Turkey, having seen, of course, the uproar not so long ago. Do we think that the Rand gets better from here on in, considering that perhaps global issues begin to quieten down maybe a little?
Well, improved risk appetite from investors would certainly have the potential for the South African Rand to strengthen from what has been a very pressured couple of months for emerging market sentiment in general. One risk that we do still need to monitor is that the Turkish lira drama is far from over. The Turkish lira declined over 3% at one stage yesterday. I think it was as much as 4%. The structural issues with the Turkish lira simply aren't going away when it comes to central bank independence fears, current account deficits widening, inflation going to skyrocket over the next couple of months, and also fears about the economy overheating. And this could weigh on higher yielding currencies as a whole, which would include the Russian ruble, Brazilian real, South African Rand would all fall into that basket. But the positive news, away from something you can really dictate, which is the Turkish lira crisis, is that we can perceive this news of a trade breakthrough between the United States and Mexico as some comfort that President Trump does not want to engage in a global trade war, and that everything that he's doing with this very hardline approach is about trying to get better deals for the United States. And if we do see more progress on the trade front, we will see more risk appetite in the market, very positive stocks, and it should provide encouragement to purchase emerging market currencies as a knock-on effect, which of course would be very positive news for the South African Rand.
Yeah. Jameel Ahmad, really appreciate your time there, Global Head of Currency Strategy and Market Research at FXTM. Martin, on the equity front here locally as well, it has been a time, of course, of earnings, so we've been looking at that quite a bit. Even Supergroup coming out yesterday, that logistics company. How are things really looking on the, shall we say, on the industrial front?
Definitely better than we were a year ago, Arabile. If you look at the results, I mean, HEPS up at 19%, revenues up 19%, and it hasn't been the easiest of operating environments. Supergroup also stating that they are looking at further acquisitions locally, which is quite interesting. They feel that there's a lot of opportunities that are presenting themselves as a result of a sort of a choppy environment within the sector. So maybe some bargain buys available to someone like Supergroup. They also, say that they wouldn't be paying a dividend this year, rather targeting acquisitions and possibly share buybacks going forward. But an excellent set of results from Supergroup, and it looks like things are improving for that sector.
Yeah. What do you make of this earnings season, though? Has it lived up to what we've sort of expected? How difficult have things been considering the local economy? We used to say that, equities would prosper despite the economy, but it seems that the economy is taking its toll.
No, it is. It's definitely been a very, very tough period. I mean, we saw in the retail results specifically, we've seen that something like the ShopRite results that came out, we can see that the consumer's been under pressure for some time, but there seems to be a pulse a little bit, especially if you're finding that your industrial stocks are starting to show a little bit of life, and that bodes well possibly going forward over the next year or so.
Yeah, and let's take a look at Telkom as well. The CEO is hopefully somebody we'll speak to just around 20 past as well. How far do you see that company really being able to manage its expenses? Is that 18,000 employees and may even cut even further?
Yeah, I think we'll see that across sort of a lot of the sort of partially state-owned or state-owned companies over the next while. I think a cut in expenses, specifically maybe job cuts might be on the card for a lot of them, but also it's not an easy thing to do, but it can be quite positive to increase the margins. They are under pressure as a result of moving towards global standards, moving towards cheaper data, cheaper fixed line sort of costs. So trying to stimulate the consumer a little bit. So one might see more of this, but a little bit of short-term pain maybe for a longer-term vision for these companies.
Juan Strauss, Head of Strategic Investments at ShareNet Wealth. Truly appreciate your time.